Lyn Alden joining in, founder of Lyn Alden Investment Strategy. Lyn, very good morning to you here from Mumbai. Just on trade fears, in your view, do you think that that's no longer a factor to worry about, or there could be more surprises down the road as far as the Trump administration is concerned?
Thank you for having me. I view it as still a factor, but I think the main thing is it's no longer an escalating factor. I think he's tested the pain tolerance in markets, and I think most markets are kind of forward-looking and saying, we don't know exactly what tariffs are going to look like over the next 3 months, 6 months, 12 months, but we've probably seen the peak level of intensity back a couple months ago. And so I think the markets have mostly moved on, and now they're focusing on his remarks around the next Fed chair, interest rate policy, and other things that are, in addition to tariff policy.
Okay. What do you make of everything that's happened in the recent past? So geopolitical tensions settling down somewhat, relatively speaking, and very quickly you saw the risk premium on crude being taken off. And from that context, everything that's happened on the currencies as well, the various pairs that you track, how would you look at emerging markets at this juncture?
Yeah, so as far as macro impacts are concerned, the geopolitics was about as muted as it could be. It didn't spill out at almost at all into global energy markets after a brief concern. No major disruptions there. So that is positive for emerging markets. We've also seen a slight downward move in the dollar index, which continues a bear market that's already been in. I've said before that I'm a buyer of emerging markets on dips. I think basically the next multiple years are probably good for most emerging markets, or at least in aggregate. And so I continue to be a buyer. I think, and we've seen further remarks since in the past week or so, where Trump is making it very clear that he wants his next Fed chair to be a dove, and they're already kind of talking down forward rate expectations from the Fed. And so that all else being equal, I mean, there are other factors as well, but all else being equal, that should be dollar bearish, having a more dovish outlook on forward rates. And so that's all else being equal, beneficial for emerging markets because it allows many of them to be, potentially more dovish as well. They don't have to fight as hard to keep their currencies stable.
One question: How does crude play a part? Is this the new normal? Because there's an OPEC Plus decision ahead, and the prices have fallen nearly 13.5% last week.
I think for the next several months, we're probably in a new normal right now. One of the things I'm watching is that very gradually, U.S. shale oil production is kind of flatlining right now, and so we're no longer really increasing structurally or even cyclically. And if you look at drill rig counts, they're down. And so in the coming months, we probably should expect at least minor deterioration in U.S. production. And over the course of multiple months or multiple years, I think this will begin weighing on the oil market and potentially provide a catalyst for the next leg up, the next bull market. But right now, the market's well supplied. Demand is overall not particularly explosive. There's still a lot of uncertainty globally around tariffs, around U.S. economic policy, and the Chinese overall slower economic growth. Those are weighing down. And OPEC Plus is ramping up, as you mentioned. And I think that the deciding factor, but not right away, is going to be U.S. shale oil rolling over, because at these prices, there's really not an incentive to reinvest back into new drilling. And so U.S. Oil companies are mainly focused on shareholder returns, focusing on some of the most profitable segments. But at these prices, it's not very conducive for them to expand supply.
Okay, Lyn. We'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time.